if the market is holding on to the recovery, at least at the moment, there is that order inflow at the bottom of the screen from NBCC, so that stock is seeing a bit of a reaction. But other than that, it's the banking index which is holding one end of the market today, especially HDFC Bank, and then the others from the IT sector, the likes of Infosys, etc., are also doing okay. So the market at least holding on to the green right now. But the big question is, how long do we hold on to the green, and is there a bottom of sorts in place? That's something we'll try and decode with Nimesh Chandan, the Chief Investment Officer at Bajaj Finserv Asset Management. Nimesh, thanks so much for dropping by to our studios.
A pleasure to be here.
Great. So that's the first question, because the last couple of months have been a bit dicey for the markets, and we are in the correction territory now for what it's worth. But from here on, do you expect a lot more sideways move, or do you expect that within the next 3 to 6 months we'll resume sort of that swift bull run?
So Robert Schiller once said that corrections in a bull market come like a thief in the night. You cannot really time it. So obviously whenever it comes, people get a bit surprised and shocked. And this correction especially was triggered by one set of investors, the foreign investors, selling in a very intense way in, say, time crunched within 1 month. It's a record selling within that. So I think that's what got people a bit worried about this correction compared to any regular correction that comes in. But because of this correction where a lot of large cap stocks have fallen quite sharply, there are opportunities to pick up good companies at good valuations. So while I believe that once this selling fades away and looks like it's fading away, the markets will bounce back. But there will be a higher bounce in companies which are like a coiled spring, which have valuations which are attractive, results which have been good, and outlook is also good.
Right. So this valuations attractive. Are you just finding it when it comes to large cap, because mid caps and small caps have also fallen, and there are also some pockets. There might be some pockets in that segment also where valuations could be attractive, or you're just focusing on large caps as of now?
So interesting that large caps have been a space which actually went up the least last year, but have corrected almost as much as small caps and mid caps in this space. So their opportunities seem to be more. So risk reward in large cap is better. Definitely because of this correction, a lot of companies in small cap, mid caps are now trading at better valuations, and those which have, say, mega trends in their favor, which have strong tailwinds for growth in the next few years, those become attractive plays at this time. But it is difficult to generalize them as a category, but if you look at some of the numbers, they're still trading about 1 standard deviation or 2 standard deviations above their historical valuations. So I would say not all small caps or mid caps are expensive. There are pockets now which have become attractive, but overall if you look at the space, large caps seem to have better risk reward ratio than the small caps and the mid caps.
So say suppose you have 100 rupees, out of that how much will you put in large cap, how much will you put in mid cap, how much will you prefer in small cap?
So typically, say we have a flexi cap fund where we have freedom to choose between these. So we have about 55% in large caps and the rest 45 split almost evenly between mid caps and small caps.
Since we're talking about large caps, one of the most underperforming sector of sorts this year has been FMCG. And partly for a reason, because we were talking about the election kind of momentum to go away, money coming to people, monsoon being better than expected, rural recovery was expected to pick up. But if you look at the Q2 earnings, the biggest headline that we've got is the fact that consumption is slowing down a bit, whether it was autos, whether it is staples, whether it's discretionary. How are you looking at consumption? An opportunity to buy the correction, or there is a reason why there is a correction in these stocks?
So we find the entire consumption space quite attractive, which includes FMCG. So typically people just take FMCG as synonymous with the entire consumption space. But we look at many other consumer discretionary sectors, say consumer services like QSR, hotels, travel, all these also within the consumption basket. Many of them are trading at very attractive valuations. Now, typically in FMCG, there were high hopes of recovery this quarter, which did not come through. And there were some reasons behind it, which are all transitory. The long election cycle, the late government spending that has come, monsoons creating havoc in some of the regions, because of which goods and services, transports were difficult. So I believe FMCG also is attractively placed, selectively of course, but many of the issues that they faced in this quarter are transitory. Now if you start looking at quarter and the second half of the year, you see the festive season picked up late, but it's picked up well. Commentaries from the rural side is very strong. Also, the wedding season this year has more days than last year and expected to be a bumper wedding season also. So these will automatically get normalized. The small misses in growth in the last quarter will get normalized there. And the runway is quite long for these companies.
Yeah, no, but since we're talking about consumption, the biggest disruptor of sorts of late has been quick commerce, and we're just seeing the numbers from the likes of Honasa in the BPC category at one end, how kind of they are trickling down, how quick commerce is having an impact on the likes of DMart, etc. What's your sense on these some newer niches of business that we're getting, the Zomatos, Swiggies, and Honasas of the world?
So because of customer upgrades, customer expectations going up, and because of technology, these quick commerce companies which make shopping easy for people, those have become quite convenient, and naturally people have picked them quite quickly. Making easier, say, growth for consumption is also UPI payments. You look at easy financing available. So these are also areas which are helping consumption growth in a big way. So we are just at the beginning of some of these trends, and we will see multi-years like these trends unfolding, and companies which are present in these areas have a strong tailwind for growth.
Right. As you were mentioning that there are multiple mid caps and small cap which have corrected. So PSUs and defense and railways which have multiple tailwinds even going forward. So we have seen a steep correction in these stocks. So do you see value buy in PSUs, specifically defense and railways right now after the correction?
So even when PSUs and defense had a rally, we've been holding a position that in PSUs, you cannot generalize these varied businesses as like one block of companies and re-rate them and de-rate them quickly. In fact, whenever people generalize, they pay the wrong price. So there is an opportunity to sell or buy when people start generalizing them. So PSUs, we are bullish but very selectively. In terms of defense, unfortunately, this is a very narrow theme. And when there are narrow themes which come in flavor or in glamour with the crowd, they go to high valuations very quickly and very sharply. And if there is even a small problem or an issue that comes in, they also correct quite sharply. So I think themes like defense and all, you have to be selective, but you have to be ready for a very volatile ride. Whereas in PSUs, opportunity is there to pick up some of these companies which have been, say, sold down as a category without looking at what business they are doing.
Okay, well now when it comes to banks specifically, even before this correction, banks were cheap. Now, or even now they are cheap. But are you preferring private banks, PSU banks, or NBFCs, or the capital market ancillaries? What is your pecking order here?
So companies that are at very good valuations doesn't mean that they will start moving the next day. They have to have a trigger. So banking space, especially private banking space, has been an area which has been trading at a low valuation since almost last 1 year. But there have been lack of triggers. In fact, there were some negative triggers in terms of deposit growth being slow, the cost of deposits going up and all. But I think we are at the fag end of those issues. We should start seeing re-rating from here on. Especially we are very bullish about private banks space because asset quality is good, credit growth is decent, and the margins are healthy. So these come as very attractive opportunities, and especially, as I said, some of these areas which will start seeing a strong bounce or will lead this up move, banks, I believe private banks would be the one.
Okay, private banking space could be one of those leaders in the bounce back. Thanks so much, Nimesh, for dropping by to our studios. Really appreciate that.
If you like this video, then like, share and subscribe to ET Now.